the Wilshire 5000 used to have more than 5,000 companies in it.
Yeah.
Now it has something like 3,800. But think about that. We have fewer and fewer stocks that are actually being traded today, but more and more money chasing this fewer number of stocks. So in many ways, that sort of justifies why we continue to have elevated PE ratios when you look back over the past 20 plus years.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Hello and welcome to the Bull of Wall Street podcast. I'm Jim Worden, the Chief Investment Officer for the Wealth Consulting Group, and I am thrilled and delighted to have as our guest Sam Stovall, Chief Investment Strategist for CFRA. Welcome, Sam.
Hey, Jim. Good to talk to you.
So you've been in the business a long time. I was looking through your bio and I saw that you were a chief investment officer for Dean Witter Reynolds prior to S&P Global, and you were at S&P Global for 27 years. But tell us about that journey. That's super impressive.
Well, actually, there's a little bit of overlap there. My father worked at Dean Witter Reynolds, and his father worked at Reynolds and Company starting back in 1932. So, grandfather at Reynolds, I was in the mailroom at Reynolds in the late 1960s. But my career started on Wall Street with Argus Research, then at Standard & Poor's, and S&P decided to get out of the equity research business that had started in 1860. There really was a guy named Henry Varnum Poor who wrote research reports on railroads, but S&P sold the equity research department to CFRA in the latter part of 2016, and that's where I've been for 10 years.
Wow, that's incredible. So I have to ask you, I've seen the movie Pursuit of Happiness. Did you know or come across Chris Gardner when you're at Dean Witter?
No, I did not. Certainly, I've heard of him, and I've had the pleasure of meeting him at the Securities Industry Institute down in Worden several years back. Nice fellow, and he certainly overcame an awful lot of challenges.
So I understand that are you still in the DC area?
I am in Allentown, Pennsylvania. CFRA decided to remain 100% remote after COVID. Our headquarters was in the DC area. We had an office up in New York, which is where I was. But once we decided to remain 100% remote, I thought, gee, why pay New York taxes and New Jersey insurance? So I moved to where I went to college, which was Muhlenberg College in Allentown, PA.
Oh, wow. That's incredible. And it's what you said about your father and grandfather working there at Reynolds. I mean, that is pretty amazing. And so this has been quite a journey for you. So I remember years ago, I tried to get a job. It was Morgan Stanley Dean Witter back at the time, and I didn't get in, but they were very highly regarded. And I remember S&P, you guys had the stars ranking, and this was kind of like it was independent. It was analysis that was not coming from any one firm that was on Wall Street. So tell us about that. Tell us about how that's evolved and how your role has evolved. I mean, you've seen a lot. Tell us about that.
Well, I joined Argus in the mid-1980s, so I experienced the crash of '87 firsthand. I actually thought it was very interesting from a historical perspective, since I was a history major in college. Also, I didn't have any money. So at the time, I didn't really have anything to lose. So I could focus on the historical aspect of the crash itself. But then moved over to S&P. I've always been very interested in movements of the market. And so I constantly monitor the strength, weaknesses of particular areas. I've written 3 books on investing, 2 about sector rotation, and then 1 called The 7 Rules of Wall Street, which are practical portfolio building tools using old Wall Street sayings like "let your winners ride," "as goes January, so goes the year," and "who says there's no free lunch on Wall Street?"
I love it. I love it. Maybe the trend is your friend is one of those too.
So it certainly is. Actually, a very simple model looks at the end of each month. You see which were the 3 best performing S&P 500 sectors over the last 40 weeks or 200 days, and you hold them in equal proportion for the coming month. And then every month you reevaluate. And going back to 1990, it's beaten the market about 2 out of every 3 years, adding about 300 basis points per year, knowing full well that past performance is no guarantee of future results.
Sure. So you I'm guessing you're a history major and you're just curiosity for markets has really helped you become quite the market historian to know all of this. And I mean, I'm curious to understand and just learn from you with all this, all the time that you've studied the markets from, many, many years ago, decades ago, and then include the time that you've been in the market. What would you say are the things that have just really stayed the same? And what are the things that have kind of evolved some, maybe changed a little bit? What would you say are the biggest changes or the biggest things that people think may have changed, but they're really still the same?
Sure. Well, a lot of times people will say to me, Sam, why do you bother looking at price performance history? History ain't what it used to be. And they say today is so different from 5, 10, 20 years ago, which I agree with. But the one thing that really drives the market has been the same since people started trading stocks centuries ago, and that is human emotions. I jokingly say that the best bit of investment advice I ever got came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So I think essentially, in this day and age of instant information, people can experience both fear and greed at the exact same moment. So they have to realize what kind of an investor they are. If they are disciplined and can block out the noise, great. If not, well, then embrace a rules-based investment approach to do the same thing.
That makes so much sense. We try to do that. I know we have some different models and we try to make things very much rules based, and that there has to be some economic sense to the rules and a rationale to the rules. But I feel like that is an area, and like you said, because of the instantaneous information that people get, they can act on their emotions for good or for bad more frequently probably now than they could before.
And you asked, well, what has been changing? Well, I remember when I first started in the business, there was something called the Rule of 18, which basically said if you take the PE on the market plus the rate of inflation, if it equals 18, you have a fairly valued market. Then it became the Rule of 20. Then it became the Rule of 22. And now nobody talks about it. One reason I think is because the Wilshire 5000 used to have more than 5,000 companies in it.
Yeah.
Now it has something like 3,800. But think about that. We have fewer and fewer stocks that are actually being traded today, but more and more money chasing this fewer number of stocks. So in many ways, that sort of justifies why we continue to have elevated PE ratios when you look back over the past 20 plus years.
Well, and to think that we have not one, but multiple companies that are like 4 trillion, 3 trillion, 2. I mean, I feel like back in the day, when you and I were early in the business, you've been there much longer than I have, but like that was kind of unheard of, right? Like $1 trillion company, but now you get companies that their market cap is bigger than the GDP
Sure.
for a lot of countries.
Exactly. Well, a lot of people, some phrases which were started, more than 125 years ago, calling somebody a millionaire really meant something. And it still sounds like a lot today, but it really isn't. A lot of people question, gee, can I retire and live on $1 million? So I think we also have to realize that we should be looking at percent changes when we see the daily performance of the markets or of stocks. Don't look at the Dow. Oh, it's up 250 points. It's up 500 points. Well, it basically, gained 10,000 points since May of last year. So
Yeah.
the raw numbers themselves can be deceiving.
Do you think that, because we looking at the Dow is one of those things that I feel like we looked at, and I remember in 1999, and I was starting in the business, and the Dow hit 10,000. That was a big deal, and now it hits 50,000. But do you think more folks are rightfully looking at the S&P 500 or the Russell 1000? Or are they still, a lot of folks kind of looking at what the Dow does, even though it's only 30 companies?
Sure. Well, the Dow is easy to explain. It does have a long track record back to 1896.
Yeah.
It's also 30 stocks, so it's fairly easy to know those names and to understand what is driving it. And you have been seeing technology firms be added to the Dow 30. Of course, you don't have utilities or transports in there.
Yeah.
And at the same time, you've got about a 95% correlation between the S&P 500 and the Dow in terms of annual performances. So, they're not as good as the Rockettes, but they do tend to march in lockstep.
I love it. So Sam, if you don't mind talking about, you mentioned sector rotation a while ago. That's something that we try to incorporate. We look at it, we look at the fundamentals, we look at technicals, but tell us about your view of sector rotation. Because, in my mind, well, at least the clients and advisors I talk to, sometimes they get this idea that this is very smooth money flowing from one asset class to another, one sector to another. But I feel like what we're going through right now, particularly, this is not smooth. What do you think about the current environment? What do you think about sector rotation in general?
Well, certainly, I think sector rotation is something that I have written about, and that's what those two books were about in the 1990s. And my schematic about sector rotation and how stocks tend to anticipate changes in the economy is found in many of the Fidelity documents. So
Wow.
it is certainly something that happens. And right now, one could say, gee, it seems as if the late cycle and defensive groups are really in the limelight right now. So energy, materials, industrials as late cycle, consumer staples as defensive. But the real question you have to ask is this a short-term bump because we felt that technology had gotten a bit expensive? The S&P technology sector was trading at 62% premium to its 10-year PE ratio on forward estimates. So things were getting a bit pricey.
Mm-hmm.
And I think when Ed Yardeni said that he was dropping his outlook on tech and communication services to neutral, he is a guy to be respected. And so I think a lot of people were looking at their own portfolios as a result. And we are looking at periods of high elevation. Last year, the S&P 500 was trading at 2 standard deviations above its 20-year average PE ratio. The Buffett rule, which is the S&P 500 market cap divided by nominal GDP, it used to signal warning when it crossed above 100%. So, like a traffic light was yellow at 100% and red at 120%. Well, it's, depending on which measure you use, it's at or above 200% today.
Mm.
And so when you also then think about something a little closer in terms of time, midterm election years are by far the most disappointing years in the 4-year presidential cycle. They've gained an average of only 3.8% since World War II, risen in price only 55% of the time, which is really just slightly better than a coin toss. And
Hmm.
it's experienced the deepest intra-year uh, drawdown of 18% going back to World War II. So, as Betty
Wow.
Davis once said, fasten your safety belts. It's going to be a bumpy ride.
I love it. So what do you think about the current sectors? Are these sectors going to stay there for a while, or are we going to continue to see some rotation?
I think at least in the near to intermediate term, we'll probably end up continuing to see some rotation. Um, Certainly with energy and materials doing well, the commodity and chemical companies, diversified chemicals. That was the word I was stumbling on. So commodity, diversified specialty chemicals are actually having their day in the sun, and it's good. It's not just the precious metals that are doing well.
Yeah.
It's also some of the industrial metals, energy because of the uncertainty surrounding the Middle East with tensions with Iran, etc. So I think that could be around for a while, but I wouldn't stay too long
Mm.
because what usually happens is that once the uncertainty of midterm elections has run its course, meaning by around the end of October, that 12-month period from October of midterm election years through October of the following year has never declined since World War II, and the average gain was 16%, with investors
Wow.
moving back into those areas that had underperformed.
Interesting. So, and that would that also favor like technology and consumer discretionary as well, some of the other cyclical names?
Yes. I mean, if you take a look at the software companies, which has really taken it on the chin,
Mm.
application software and system software down more than 30% from peak to trough since late October,
Yeah.
are right now the application software stocks are trading at about a 35% discount to their 10-year average PE on forward estimates. And the system software companies like Microsoft are trading at about a 15% discount. So I think investors don't want to wait too long, and they do want to be picking up some bargains, because when you look to earnings growth,
Hmm.
S&P is expected to be up about 12.5% in 2025, 13% in 2026, and 16% in 2027,
Mm.
according to S&P Capital IQ consensus estimates. Technology is still expected to significantly outpace the broader market.
That's interesting. Well, and you mentioned you mentioned software, so we have some models that are quantitative driven models that multi-factor, and we look at the different things like momentum and trend, and but also value and quality, and to see some of these software names that were really considered growth names trading at these very very big discounts. Do you think that some value managers are going to look at these and say, well, this is never traded at like 13 times forward earnings, like maybe we should own it, or would they stay away from it just because it's mostly growth all the time?
No, I first off, I agree with you that fundamentals tell you what, but technicals tell you when and how far.
Yeah.
So you really have to look at both of them. And I think that what's going to happen is that with some of these growth areas getting beaten up to the point where they look attractive to value investors, then I have a feeling you're going to have both sides of the coin licking their lips and buying some of these beaten down stocks. So yeah, it's basically opening up the opportunities to the other side of the equation.
It feels like a good environment if you are a active manager, if you're a stock picker, if you can have a little bit of insight in terms of like the areas that might do better than others because of the pricing is better and maybe the momentum is starting to pick up. but there's a lot of money there's so much money. One of our prior podcast guests talked about all the money going into indexes, different types of indexes. Do you think that this is still going to continue to be one of those things that, the tail kind of wags the dog because there's all this money going in and getting allocated to, index members?
Well, I think money is going into the indexes, but at the same time, I think they're going into ETFs. And
Yeah.
that's why the retail investor really has taken a leadership position within the marketplace. I mean, they look at the different strategies, whether it's high momentum, value plus momentum, momentum alone,
Mm,
deep value. Maybe it's dividend aristocrats. Maybe it's taking advantage of a weaker dollar, stronger dollar, and so forth. So a lot of strategies can be put to work in a single ETF. And at the same time, if it allows the retail investor not to have to monitor 20 plus stocks on a daily basis, in a sense, either you can do the driving or somebody else can do the driving. I think, like the old Greyhound commercial, leave the driving to us. Uh,
mm.
so with the ETFs, and at the same time, people don't pay attention to the valuations of the ETFs. And
Hmm.
so maybe that could also be a reason that the valuations of the overall market have been a bit stretched for a while, is because the retail investors buying into these ETFs aren't really looking at the valuations, but looking more at the strategy.
That's interesting. Well, and we've seen with the price of silver and the price of gold and these wild swings in Bitcoin being one of them, but silver being one of those areas that there may not have been a ton of money that's been exchanged via futures and options on futures, but then all the ETF money, it seemed to just kind of maybe exacerbate that. I don't know if you have any comments or thoughts on silver, but
Well, I think
pretty wild.
silver tends to be the poor person's gold.
Yeah,
And I think the reason that gold did well is because of the trade tensions that are going on around the globe. Central banks are saying maybe we should be owning gold instead of treasuries or the US
yeah,
dollar. Also, with valuations being stretched from a longer term historical perspective, I think investors they didn't necessarily want to be gravitating toward bonds, which was the prior safe haven, because of what we saw in 2022 when stocks and
sure.
bonds went down. So they're looking at hard assets. And at the same time, with the value of the US dollar going down, that tends to add to the price improvement of of these precious metals, because they're priced in gold. So, priced in dollars. So with gold doing well, and then consumers saying, well, I can't afford the gold, but I'll buy the silver. And they probably also have jars of old silver that they had when they were collecting money back in the 1960s, as the government was taking silver out of the coinage.
Yeah, I have an old coin collection that has some of those silver coins, but prior to, I think it was 1964, they were
That was the last year of
100%,
100%, I mean, of
yeah, 100%
90% silver.
silver.
And then you had the Kennedy half dollars that were 40% silver up to 1970. And then
Yeah,
everything was clad after that.
it's interesting. So you mentioned bonds and you mentioned kind of like asset allocation. Do you think, a lot of people ask, and I've been to different conferences, been on panels, sometimes people ask, is 60/40 dead? Is it changed? Should people look at it differently? And I just wanted to get your thoughts on that because of, bonds didn't really help much during 2022, but that was just kind of a strange year with inflation and higher rates.
Right.
What do you think of 60/40?
Well, I mean, it's certainly a long-lasting rule of thumb, but even those rules of thumb tend to change. I mean, you think about it.
Yeah,
Why is it 60/40? Because it tends to be the best risk-adjusted return over an extended period of time. Well, it used to be the same with U.S. versus international stocks, where it would be 60/40 within the equity exposure, or within a 60% equity, it would be 45% US, 15% international. But if you look over the last 15 years, the real question is why have any international at all?
Yeah.
Especially if 40% of the revenues from companies in the S&P come from overseas operations, why add an additional level of risk, meaning currency risk,
Sure.
uh, to your overall portfolio? So I think it really, again, goes back to what can an investor stomach? My father never owned a bond. He basically said, if I want income and I want defensiveness, I'll own utilities.
Oh.
Because utilities do end up being bond proxies that are taxed more favorably than bond income is, and they also have the potential for price appreciation. So it all depends on the client and
Mm.
advisor relationship, I think.
It's interesting to think of it that way because I guess, with individual stocks, they tend to be a better inflation hedge than owning just fixed income. Maybe I guess
Oh,
you could argue
absolutely.
that bank loans could, but they're not great for, hedging inflation.
Exactly. I do a class every year at Wharton at the Securities Industry Institute called Using Stock Market History as Virtual Valium, or
Mm.
basically by understanding the movements of the market can help you calm down. And
Mm.
one of the slides I show, obviously, is how have stocks done over versus bonds versus inflation versus cash. And you get a very good understanding as to why you would own stocks over bonds. But then
Hmm.
when you show the volatility of stocks compared with bonds, then people say, oh, okay, now I can appreciate why. But at the same time, you don't necessarily need to have bonds to offer a correlations or diversification within your portfolio. In the book that I wrote that nobody bought called The Seven Rules of Wall Street, one of the chapters is who says there's no free lunch on Wall Street? And a
Yeah.
free lunch is when you get something for nothing. So if technology is the poster child for growth and volatility, what is possibly the poster child for stability, and that's consumer staples. I like to
Mm.
say that when the going gets tough, the tough go eating, smoking, and drinking. Uh, so interestingly enough, the best performing sector by far, going back to 1990, which is as far back as S&P has sector level data, was technology. A
Mm.
compound annual growth rate of more than 14%, but a standard deviation in excess of 30%.
Yeah.
On a risk for reward ratio basis, you actually did better in the market than you did in technology, if
Mm.
that's what your measurement is all about. Um,
Sure.
but a 50% weighting in tech and a 50% weighting in staples rebalanced annually since 1990 gave you 93% of the return of tech, but with 40% lower volatility. And the cumulative growth from 1990 through the end of 22, you were ahead with this 50-50 portfolio than if you had been 100% in technology. So this kind of a strategy is a one that somebody could embrace. It does offer diversification and also gives somebody a chance to brag. If the market's going up, you can say, "Hey, I own half of my portfolio's technology," and if the market's going down, well, I'm smart because half of my portfolio was in the defensive consumer
Consumer
staples.
staples. That's so fascinating. So we have some of our quant models look at that, and it's not just those two, but I 100% get what you're saying, and I always try to tell them that we don't want to just own those things that are flashy. We want to own enough of those boring names, Coca-Cola, in some insurance companies, they're not staples, but boring, stable
Sure,
trend,
sure.
pay a
Boring can be
dividend.
beautiful.
And like those tend to work real well when the stuff hits the fan, right? So,
Well, and I also believe, if you were to ask 100 investors, which is a greater motivator, fear or greed, uh, a great majority would say fear. And actually, that is quantifiable. If you go back over several decades and you count up what is the average uh, let's see, percentage of days during bull markets where the volatility was 1% or more. Survey says 15%. But
Mm.
during bear markets,
Mm.
45% of those days had volatility of 1%
Oh,
or more.
wow.
So obviously, most retail investors are imitating Edvard Munch's The Scream when we do go through that
Yeah.
kind of volatility. And so as a result, I think that's why you have to realize that some of your best days are soon after some of the worst days.
Yeah. That makes sense. And this is why we try to coach advisors who coach clients that when things feel bad, this is not the time. When you're especially when you're emotional about it, this is not the time to make
Exactly.
massive changes. And again, we do have some models that are a little bit more tactical that will systematically get out, but they're based on rules, not emotions. And so
Sure.
sometimes those things work great. Sometimes they often protect in terms of the risk because you don't know whether we will have a rollover with the market or not.
Right.
But they're
However,
systematic in nature.
However, 85%, actually 85 plus percent of all declines of 5% or more ended before they broke below the 20% threshold. And,
Mm,
and this is going back to World War II. And those pullbacks and corrections, on average, got back to break even in only 4 months.
wow.
So the amazing thing is, by the time a nervous investor worked themselves up into a frenzy to say, I've got to call my advisor to lighten up on equities. And by the time that client had harassed the advisor frequently enough to make the advisor say, fine, I'll lighten up so long as you stop calling, then by then the market's probably already on its way back to break even.
Yeah, that makes sense. And I feel like sometimes the media plays a role in that too, because it's a lot of
Sure.
fear and like we need to get out and if people are watching that, all day long, if they're retired, they're looking at that, then they can throw in the towel, I guess,
Well,
capitulate maybe at the wrong time, the worst time.
that's why the old saying, if it bleeds, it leads, because adrenaline enhances memory retention. That's why we recall where we were when tragic events occurred. And so essentially, what financial media is doing is saying the world is coming to an end at midnight. Tune in tomorrow to see if it really did.
I love that. If it bleeds, it leads. And this is something that we look at. So what do you think of the current dynamic right now? Because we the markets have been doing pretty well. There's a lot of cash that's on the sidelines, roughly 8 trillion when you just look at money market funds. But if you add in, checking accounts, savings accounts, CDs, it's, like 29 trillion or $28 trillion. And, we look at the trend on this and normally when the markets are doing well, people are removing the cash. They're spending it, they're investing it, but we've seen this odd situation where consumer sentiment is really, really weak. It feels as bad when you look at it. It looks as bad as like during the pandemic. Cash is high, but the market is doing well. What do you make of it all?
Well, I think what it implies is that investors are focusing on the fundamentals. They're looking at earnings growth, and they're seeing, you know what? We thought that we were going to see only 7% earnings improvements in Q4 of 2025. Right now, we're on target for a 12.5% gain according to S&P. So this will be the 65th quarter out of the last 67 in which actual results exceeded end of quarter estimates. So once again,
Wow.
management has done an exceptional job of managing expectations. And so I think with a lot of people warning about midterm election years, myself included, just sort of
Mhm.
stating the facts. And if I'm wrong, I'll just blame history. Uh,
Sure.
what it basically says is that high volatility, low return on average. We just scored our third double digit annual gain. And only 3 times since 1942 have we
Mm.
had a four-peat. And only once have we had a five-peat. So, it's a rare thing for us to have a
Mm.
double-digit gain once again this year. But my target is 7,400 for the S&P by the end of this year. I think it's going to be a good year, not a great year. Like
Yeah.
the old bad joke, what's the difference between an all-weather radial tire and a 30% total return? One's a good year, the other's a great year.
I love it. No, that's great. That's pretty incredible. So 65 out of 67, did I hear that correctly?
That is
That's
correct.
how many quarters the S&P 500 like we beat earnings estimate. Is that kind of what that number was?
That's
Wow.
right. So if we were estimating 7 and it came in at 7.5, 8, 9, 12, 15, it counts as a 1. And
Yeah.
so 65 of the last 67 actual results beat forecasts.
That's incredible. I've been looking at it for a long time and I feel like, and I look at it at the stock level, but then I aggregate it week by week and it's typically, I feel like for a while, it's been like 70 to 80% of the companies reporting are beating.
Right, right. And I think it's because companies do a very good job of managing the expectations, guiding the analysts lower, even if it's just by a penny. And also, 76% of the stocks in this earnings period have beaten expectations.
Mm.
So it's not just the magnitude, but it's the frequency, the number of stocks that have done so. So that's a good sign, and I think also just the fact that the market is rotating, it's not retreating. We're still only about 1% away from another all-time high on the
Mm.
S&P 500, even though we've had so many sub-industries within the S&P in negative territory. So I think investors are saying, do I really want to fight the trend and the Fed?
Yeah, that's interesting. Well, let's take a couple minutes and kind of talk about some of the drivers that that we're seeing that are out there, and it's kind of hard to not have a podcast and not talk about AI at some point with all the money that's being spent and infrastructure build out, and you have. I feel it's very different than late 90s in the sense that you got companies that are actually making a whole lot of money. Some of them, I mean, some of them, that are still building, there's kind of this big question mark. They need to make money, but, companies like Nvidia and some software companies have been making a lot of money. Chip companies, memory companies like Micron have just been, and they're booked out for, 2-3 years. Where do you see this going with AI and infrastructure? And I mean, it feels kind of not really like a straight line. That is kind of a bumpy road to kind of get to that end result. But how do you see it?
Well, I do think it's sort of interesting how a lot of people like to say that investing is gambling. And I say, really? Well, if that's the case, I would love to know which casino pays the gambler 80% of the time. Because since World War II, the S&P has posted a positive total return 80% of the time.
Yeah.
So everyone is looking for reasons, again, because fear is a greater motivator than greed. They're always trying to decide what could go wrong.
Yeah.
And I think you're dead on by saying what's different today than the 2000s was back then. They didn't have any earnings. They were trading on fumes and
Yeah.
expectation. Today, however, they are trading on earnings growth. Just case in point, looking at the semiconductor sector is expected to post 46% growth this year
Mm.
and then 67% growth in 2026. Now,
Wow.
granted, their trees don't grow to the sky. So right
Hmm.
now, 2027 estimate is 30%. So
Mm.
that's down from the 67% estimate
Yeah.
for 2026, but that too could get revised higher. We're also looking at double-digit gains for all of the industries within the S&P technology sector. This year, electronic components up 50% in earnings, should be up 31% next year.
Wow.
Essentially, almost all of them are expected to see a slight slowdown in
Hmm.
earnings growth, but still looking at double-digit increases, whereas semiconductors are by far still the one that is driving the bus.
And then even the margins are still really good for some of these companies, right? I mean, I see some that are at 60, 70%, not, not rare to find those that are 40, 50% margins. Do you think that continues, or are we going to get to a point where, okay, well, margins comes down, and maybe revenue growth slows? It seems
Oh,
like
sure.
eventually we'll get there, but no one knows, right?
Well, as an industry matures, you tend to see a lower trajectory of earnings, revenue, profit margin growth.
Yeah.
But the real question right now is: are we in an early innings, or are we still in batting practice?
Yeah.
Um, and I think that there is a lot going on because of the fact that now people are starting to question AI. What about the debt that is being built in order to build these data centers?
Sure.
What about the cannibalization of businesses because AI has been advancing? So, yeah, I do see a lot of turmoil, a lot of upending. So I think looking at both prices as well as the fundamentals, prices lead fundamentals. So you do have to
Sure.
pay attention to price actions. But just looking at the market itself, revenues for 2026 are now at 7.3%, up slightly from the
Hmm.
7.1 that was forecast at the end of December. Yet technology revenues, instead of 7%, are expected to be up 20% in 2026. And
Wow.
that's higher than the 18% expected as of the end of December. And looking at profit
Mm.
margins, S&P about 9% growth in 2026, whereas technology is expected to post about a 15% rise,
Mm.
nearly double what the S&P is. So still very solid profit margins, revenue growth, earnings growth, but I think one has to anticipate that this growth is likely to be slowing as the industry matures.
So what inning do you think we're in, or are they still in batting practice?
Well, that's a stretch, pun intended. Uh, I don't think we're in the seventh inning. No, I think that we're in very early innings right now.
Okay.
We're beyond the batting practice. But when we look at the growth numbers, the charts offered by our tech sector group head Angelo Zeno, some of these forecasts are wild. And I guess you also probably have to see a little tempering of those expectations as well.
And I feel like part of this earnings season, we're seeing some of that, right? Like they're beating, they may be beating on their earnings, they may be beating on the revenue, but they're guiding maybe a little bit lower, and then the market is kind of
Right. Yeah. Well,
repricing some of those.
I've always said that investors are no better than hyperactive first graders playing musical chairs, always trying to out anticipate the other as to when the music will start or stop. And right now, that's the way it is with technology. It's yeah, if you beat on earnings, you beat on revenues, you beat on profit margins. Oh, but like you didn't sound overly enthusiastic about your guidance. I'm going to sell. So there's some reasons why people just want to take whatever the profits they have. But Peter Lynch used to say, a lot of people are willing to take a two bagger, but they could have ended up with a 10 bagger.
That's true. Yeah, well, I guess there's just less patience, right? And some people are just kind of like, I'm worried about the future, and they think, and maybe part of the problem is they think they're in the later innings, and they're not
Well,
willing to ride that volatility, right? The volatility can be rewarding.
sure, and you also get hiccups along the way. I mean, we
Yeah,
did have a near bear market decline this time last year as
yeah,
investors worried that we were headed for recession. I
yeah.
like to say that bull markets don't die of old age, they die from fright. And what they're most afraid of is recession. But as Paul
Yeah.
Samuelson, the Nobel laureate, once said, the stock market has anticipated 9 of the last 5 recessions. So sometimes the market itself can get ahead of the economy.
Well, and I feel like sometimes the news, sometimes something comes out and people are like, oh no, I'm worried, right? It was DeepSeek. And then, it was, what is Google's new model going to do? Is that going to disrupt, other companies? And then, what does Claude do? Right. So these things sometimes come up in the media and, maybe the markets are a little bit are already, kind of wobbly, and so you get some extra volatility with it. But
Right.
But if you're a long-term investor, right, then you're looking at, hey, good fundamentals, the technicals are good, and you just got to, stick with it.
Sure. And if you want to be somebody who takes advantage of market declines, then don't reinvest your dividends, have them go into a money market that you can then put to work once the market has fallen by an average of 7%. We've had 65 pullbacks or declines of 5 to 10% since World War II. We've had about 25 corrections, which are declines of 10 to 20%.
Yeah.
And we've had 13 bear markets. So I like to say it's the 7% solution, that if the average pullback is 7%, the average correction is 14%, and the median bear market is 28%, well, then at every 7% decline threshold, put a little bit of money to work.
Put a little bit of money back in. I love it. It's sound advice. This has been a fantastic discussion with you. I could probably go on and on, but I have a couple other questions. Like, just with all your experience, a lot of experience working with different people, talking to different firms, and being the market historian that you are, and having a pretty clear view of the rear view mirror, but then also seeing kind of what's going on today. What excites you the most and what worries you the most about the current environment?
Well, what excites me the most, I think, is just having a good feeling as to what might happen based on historical trends. I am a very big believer in the Stock Trader's Almanac. I've learned a lot from Yale and Jeff Hirsch.
Yeah.
I've also done a lot of my own work, learned a lot from my father. And then, people who are just sound investors. Like Jim Stack from Investec in Whitefish, Montana, like Craig Johnson from Piper Sandler in Minneapolis. Just people you learn from. And so what excites me is that, you can keep your finger on the pulse of the market. And usually when everybody around you is losing their heads, that's when you have to say to yourself, wait a minute, are they throwing out the baby with the bathwater? I like to look at what percent of the 155 sub-industries in the S&P 1500, that's the large cap 500 plus mid cap plus small caps, what percent of those sub-industries are trading above their 50 and 200-day moving averages. And back on April 4th of last year, only 1% was healthcare distributors and gold. And that said to me that, we are at or near the bottom. And then our Lowry technical analysis arm did talk about a buying thrust. And so we shortly thereafter put out a paper saying we think that the worst is behind us. And thank goodness we were correct.
Yeah. Well, and it's hard to model, I guess, like the tariffs getting on and the tariff getting off. And like, I feel like that is one challenge with the market is
absolutely
the power of a tweet for good or for bad. Right.
And sometimes history is wrong. I mean, I did not think at first that COVID was going to be what it was, because we had looked back on all of the other viruses, bird flu, et cetera, and you really didn't have a lot of technical analysis available to you back 100 plus years ago for the Spanish flu, and things also had been quite different. So sometimes you can get a misread. So I like to say, as Mark Twain once said, history might not repeat, but it frequently rhymes. I say, yeah, but also sometimes, like the singer of the national anthem, it forgets the words.
That's true. That's a good point. Yeah, this has been fantastic. I got one last question. That we sometimes look at kind of what's happening with the labor market, and we believe that the Fed needs to be proactive in helping out the folks that are struggling. We do. Some people call this the K-shaped economy, and there's the haves and the have-nots, and there's also a lot of changes with demographics where some folks are doing extremely well, and maybe some of those are the people that have a lot of money in cash and they're not really spending it, and so then there's the whole issue with home ownership. What do you think happens with demographics and you know changing things that happen there with immigration and aging demographics, and then of course AI? Where does that take us? Some people think that we need to have like universal basic income. Others think that the solution is that there needs to be much better education for those people that are have nots. Where do you kind of weigh in on that?
Oh, well, basically, that is a progressive approach, which I think is a good one. I mean, the best way to overcome a lot of situations is through education.
Yeah,
I mean, think of how many people today have a retirement plan because either they worked at a company that had a defined benefit plan or had a defined contribution plan. And thank goodness now, if you don't opt for a particular allocation, you are automatically given a target date
yeah,
investment where you are exposed to equities, which is so important, in my opinion.
sure.
You don't want to rule out the consumer. What's the old saying that consumers stop spending only when the banks stop lending? Of course, they're not really buying homes, so they're therefore not buying for their homes that much, et cetera.
Yeah,
Uh, and demographics, we need the younger people to help support the older people.
sure.
That's why it was that the emerging markets were such a great area to invest in because their average age was a fraction of
Mm,
Japan and many of the developed nations. So I think having a good immigration policy,
yeah.
where we know who's coming in and so forth, but we do, realize that a lot of people want to come in. So let's make sure that we have enough people who can help to process these people. We need new blood into our economy.
Hmm.
And they, with their incomes, with their taxes and whatnot, will help support the country. And then through education, I'm a very big believer in financial literacy. I'm a board of trustee emeritus of WISE, working in support of education.
Oh
Uh,
wow.
its website is wise-ny.org. And what they do is they're in 48 states teaching financial literacy. And I used to go to high schools in the Bronx, in all sorts of places in New York City. A friend of mine taught down in Orlando, and I would go to a Baptist school down there to teach financial literacy because everyone says that's the one thing that is not a required course, and nobody understands why.
That's fantastic. That's so wonderful to hear. And I agree 100%. I mean, this, like, we really hit home on math, science, and English, but there's not that much that, goes into like financial literacy and what you should do and what you should not, budgeting, credit card debt,
Absolutely.
investing, right?
I taught it 2 semesters at Marymount Manhattan College. Financial literacy. This is the abbreviated winter and summer semesters when none of the tenured professors wanted to do it. And
Yeah.
the students in the end said, why is this not a required course? And I
Yeah.
think the tenured professors heard about the course. I'm not saying that I taught it well, other than the fact that it was such a good class for
Sure.
the people to learn. And they started fighting over themselves who was going to kick me out. So I only lasted a couple of semesters.
Well, that is wonderful, all that you've done. This has been such a, wonderful conversation. It's been a pleasure having you, Sam, join us. Anything that I should have asked you that I didn't, or anything else you want to say?
No, I think I got to throw in a lot of history, a couple of dad jokes along the way,
I
etc.
love it.
But I think investing is a journey. You can decide to do the driving or let somebody else do the driving.
Yeah.
But I think the key is focus on the long term.
Yeah.
Don't let emotions be your portfolio's worst enemy. If you are impatient, then acknowledge the fact you get upset if you miss a slot in a revolving door, but don't allow that to upset your portfolio because, left to your own devices, most people would buy high and sell low.
Well, this has been fantastic. Sound advice and wisdom from Sam Stovall, Chief Investment Strategist at CFRA. Thank you, Sam.
My pleasure. Thanks for inviting me, Jim.
Here's Three's Company too. Come and dance on our floor. Take a step that is new.